I'm Meg DeLuca. I'm a partner in the Stamford office of Cummings & Lockwood, and my topic is, when and to whom does a trust pay income tax? The basic point of this conversation is really what states are permitted to tax a trust. So we're going to be focusing on how states tax various trusts and what types of connections the state has to have to those trusts in order to tax the trust for income tax purposes. So for purposes of our discussion, we're going to talk about two types of trusts. The first one is grantor trusts. As you may know, a grantor trust is a trust where the income earned in the trust is taxed back to the grantor on the grantor's individual income tax return. The second type of trust is a non-grantor trust, and there's subcategories to that. It doesn't really matter for this discussion, but I'm going to tell you what they are. One is a simple trust, which basically requires that all the income go out to the beneficiaries. And then there's a complex trust, which is anything that's not a simple trust. For purposes of grantor trusts and state law, if a trust is treated as a grantor trust for federal income tax purposes, it is almost universally treated as a grantor trust for state income tax purposes, which makes it very easy for us to understand the laws regarding taxation in states of grantor trusts. There are two exceptions. They're not very notable, but Alabama does not recognize grantor trusts unless the trust is a revocable trust. And Pennsylvania recognizes grantor trusts, but not if it's a grantor trust as to the beneficiary of the trust. I'm not going to get into the details of that because we're going to put grantor trusts aside. They're not that interesting in this topic. So we're going to talk about non-grantor trusts. There are two basic premises about non-grantor trusts that pretty much universally apply. First of all, the ordinary income that's distributed to the beneficiary or beneficiaries of a non-grantor trust is generally taxed on the beneficiary's personal income tax return. So if it's going out of the trust, it's going to be taxed to the beneficiary as opposed to the trust. A trust's source income, which is income earned on assets or businesses in a particular jurisdiction or state, will be taxed by that state. So if you have a business or real estate, let's say, in New York, and you're getting rent from that, the trust will pay tax to New York on that rent. So the question then becomes, what state gets to tax the undistributed ordinary income and any capital gains that isn't source income of a particular state? And that's a difficult question, because in order to tax a taxpayer, any state to tax a taxpayer, the taxpayer has to have some nexus, that's the word, nexus to that state. And it has to be significant enough to allow the state to tax. The US Supreme Court in Miller Brothers versus Maryland said that the link has to be such that the state has an ongoing connection with that taxpayer in the particular year that the tax is being assessed. So this can change from year to year, depending on the facts and circumstances of that particular trust. And we'll get into how this can change with an example shortly. The problem with the fact that each state that has a nexus to the trust can tax the trust means that if there's more than one state that has a connection with this trust that's significant enough to allow them to tax the trust, then more than one state can tax them. And they can tax them as a resident trust on all of the income earned in that trust. In that case, they don't even have to consider necessarily that if I'm being taxed in Connecticut and New York wants to tax me too, that Connecticut and New York do not have to consider that I'm being taxed in another state. The news is most states give a credit for taxes paid to another state, so that's not generally a practical issue, but it's a possible issue if that state decides they don't want to give that credit. So as advisors, I think it's really important for us to be aware of the things that cause states to tax our trusts, because we have clients who move all over the country. We have beneficiaries who move all over the country, and trustees. We change trustees. We buy new assets in the trust in different jurisdictions, and all of these things will affect whether we can be taxed, and it can change on an annual basis. We have to evaluate it on an annual basis so that we're sure we're filing the appropriate state tax returns. But also, we want to make sure that if someone comes to us and says, you know, dude, I want to name a new trustee, and I want to name them in X state, let's call California the state, because it's one of the states that taxes based on trustees living there, you might say, wait a second, you do not want to do that because you're going to be subjecting your trust to California tax. So we want to be able to preemptively stop things that cause us to pay tax in other states. I'm going to start with the easy states. There's several states, there's actually 8 states that do not impose an income tax on trusts. And the first thing I should point out is Alabama is not one of them. That's supposed to say Alaska. So Alaska is a state, so mark that on your thing. I also want to point out that New Hampshire, while I have it in the subcategory as not being officially a no-tax state, has moved into the no-tax state bracket as of 2013. But they used to be with Tennessee, where they just had taxes on income and dividends if you had a resident beneficiary. They're no longer doing that. But if you have a New Hampshire client, or trust, I should say, that's failed to file their New Hampshire taxes up until 2013, they should be going back and doing that. Because I overlooked Alaska, I'm going to use Alaska as my example state in this scenario. Okay, so let's say you have an Alaska settler of a trust. He's using an Alaskan corporate trustee. He funds his trust with cash, stocks, and bonds, which are assets that have no situs. They're not located in any particular place. And all the beneficiaries live in Alaska. That trust will not be taxed for income tax purposes. Alaska does not assess a tax, so that trust won't be taxed. But that can change on a dime. It can change annually on a dime. And I'm going to show you how that can change so easily and does change in our practices daily. The first problem is with taxation of trusts is that states can tax trusts that are resident in their jurisdiction. But all the states do not have a consistent test to determine what a resident trust is. They look to several different factors to determine this. One, it would be the residency of the settlor of a inter vivos trust, which is a trust we create during lifetime. You see them all the time, life insurance trusts, revocable trusts, or inter vivos trusts. Residency of the testator, which is a trust created under a will, a testamentary trust. Residency of the trustees, residency of the beneficiaries, where the trust is administered, meaning where all the legwork and accounting and distribution decisions and investment decisions are being made. And in very few cases, the governing law that's written in the actual trust instrument. Several states have chosen to impose a tax strictly and with no other factors on the fact that the settlor lived in that state either when the trust became irrevocable or grantor trust status terminated. So, but a lot of cases have come down that say that's not enough. Like I have, Joe Schmo settlor living in Connecticut, let's say, and, well, actually, let's not say Connecticut, let's say Illinois. And he's moved from Illinois, 20 years ago, but Illinois is still allowed to tax? That doesn't seem fair. They say that's in violation of the Due Process Clause and the Commerce Clause of the Constitution. And so they would require a more significant nexus, another thing to link that trust to the state. But some states say, no, this is enough. We're going to let this be the only nexus that's necessary. So if you have a beneficiary who lived in Maine and decided to move to Alaska because it wasn't cold enough in Maine, they will still be taxed by Maine. Other states, and notably amongst them is Connecticut, require an additional nexus in order to tax the trust. Connecticut requires a resident beneficiary. Delaware, this should say resident beneficiary next to Delaware, so change that in your materials. Also requires a resident beneficiary. New York requires a resident trustee or corpus of the trust located in New York. And I'm going to point out Idaho for no other reason that I love the boldness of their statute. They basically try to catch any trust they possibly can, and they say if you have 3 of 5 factors, then you're taxable in Idaho. And that is either the settlor was in Idaho, the trustees in Idaho, properties in Idaho, place of administration, and governing law in the instrument. If you have any of those 3 of any of those 5 rather, then you're taxable in Idaho. Go Idaho. So the residency of the testator is very similar to the residency of the settlor. You'll see that lists basically match each other, except for 3 notable exceptions, and I'm going to explain why. Connecticut being one of them. Connecticut, Louisiana, and Michigan are added to the list of states that will tax a trust created under a will forever. If the decedent dies in that jurisdiction, they will tax them. What's notable is the reason they allow that to happen is because Connecticut, for instance, the probate court in Connecticut maintains jurisdiction over a trust created under a will forever, for as long as the trust exists. So you have that constant contact with the Connecticut court system, which creates the nexus that they think is adequate for the state of Connecticut to be able to continue to tax that trust. Michigan, same idea. Louisiana is interesting because they don't even tax inter vivos trusts. They're not even on those other lists we talked about. But if you create a trust under a will, then they will tax that trust forever. So what's important to note is that in these states, if you're sitting down with a client in these states, then you want to suggest, and I think we suggest this many times anyways, that they do their planning via an inter vivos trust as opposed to a will if they intend to set up continuing trusts for their beneficiaries, because that will get them out of these states for tax purposes. I'm not even going to talk about this slide because it's exactly the same as the other slide that we talked about with the inter vivos trusts, with the exception of the defecting states of Connecticut and Michigan, except to say there's Idaho again, and we love in Idaho because Idaho is aggressive. Next is the residency of the trustee. There's several states that look just at where the trustee resides, and I mentioned one earlier, California, and that decide that they're going to tax just because you have a trustee living in that state. And I think this came as a surprise to a lot of people, that this was one of the things that causes a trust to be taxed. So let's say in our situation with our Alaska resident, Uncle Al, we'll call him just for shorthand, if he appoints his brother Cal from California as a co-trustee halfway through the trust, then the trust can be taxed by California. So just adding a trustee that lives in one of these states is now subjecting that trust to tax in that state. So that's really important when you're talking to clients and they're thinking about changing trustees or adding trustees. Some states require not just that the trustee live there, but that there be another nexus to the state. There's Idaho again. But there's also Montana, which is an interesting one because they require that the place of administration also be in Montana. So you could have a trustee who lives in Montana, but if that trustee really isn't active in administering the trust, and the trust is actively administered in another state by a different trustee, and that state does not tax trusts based on where the trustee resides, you can avoid Montana tax by having that other trustee do the administration of that trust, principally. What's interesting about the residency of the trustee issue is that we have such complex trusts now. We put in a lot of other sort of quasi-fiduciary individuals who act on behalf of the trust, like trust protectors and investment committees and such. And the question is that enough, if they live in a particular state, the members of those committees or the trust protector, will that cause the trust to be included in taxed in that state? We just don't know the answer to that, but you really do need to think about that because if it ever comes up, you could get caught. Another nexus would be the residency of the beneficiary. These are the states that tax based on the residency. So let's just say Uncle Al's oldest child, Caroline, gets married and moves with her family to North Carolina. Okay, now we've already got a tax in California on our totally tax-free trust, remember, at the beginning, and now we've got a North Carolina tax to pay because Caroline moved to North Carolina. So movement of the beneficiaries is critical to keep aware of. The next thing would be the place of administration, and that's basically where do they prepare the tax returns, where's record keeping, where do the people who make the big decisions about the trust reside. So if they're administering a trust in one of these states, then the trust could become subject to tax in that state. So Uncle Al says, you know, I'm sick of paying this corporate trustee in Alaska all this money to administer the trust, so I'm gonna appoint my niece, Georgia, who happens to live in Georgia, to administer the trust in that location. She's very competent, she can handle it, she's an accountant. I'm gonna let her handle the administration of this trust going forward. If that's the case, now we've got a Georgia tax. So we've got California, we've got North Carolina, we've got Georgia tax. All of these are very simple, everyday decisions that our clients make that would greatly change the tax status of their trusts. Again, the only important thing on here is Idaho. Idaho is the theme of this conversation. If you have one of the 3 of 5 factors, Idaho will tax you. Finally, governing law. Now, this is not a big one, but it does affect a couple of jurisdictions. For instance, Louisiana is the big one that really cares about governing law. They say that if the instrument expressly states that Louisiana law governs, then they will tax it, whether there's any other nexus to the state. They also say that even if it doesn't say anything, but it doesn't say it's governed by another state, but it's silent on that point, they will tax the trust if it's administered in Louisiana. 2 other states, notably Idaho and North Dakota, will tax the trust or will consider taxing the trust if the governing law is in one of those states. So what if I told you that for some odd reason, Uncle Al's trust said that Louisiana law governed? Don't worry, it didn't. Cummings and Lockwood drafted that document. The takeaways for this are that you have to be aware of where your grantor resides. And sometimes if you're in a state where the grantor resides and would be taxed based on that residence, you should consider using a grantor trust so that you at least have the flexibility of getting that grantor out of that state before they die and the trust becomes no longer a grantor trust. You have to think about who you're naming as trustees at the beginning and during the course of the administration of that trust. Naming Uncle Cal in California changed the taxation of that trust. You need to include at the beginning powers to remove a trustee because Cal may not have lived in California when you named him, but he very well may have moved to California by the time this becomes relevant. And you may say, I got to get Cal out of here. We need to put in a new trustee that doesn't live in a state like that. You might have beneficiaries who reside in multiple states. You could either ab initio set up trusts that are separate for each of the beneficiaries so that you don't have someone who could be taxed based on residence, such as Caroline in North Carolina, won't be impacting her brothers and sisters who still all live in Alaska. So you could set up separate trusts. You could do what Dan and Susan talked about. You could decant the trust if it becomes a problem or sever the trust. But you need to have all that stuff in the trust instrument up front and to permit those things, at least in Connecticut for sure, or you won't be able to do it. So you need to be drafting around that. And you need to choose a place to administer the trust that's not going to cause it to be taxable. That's very relevant for professional and corporate trustees that are named because typically professional and corporate trustees take on the bulk of the trust administration duties, and therefore you're really going to be subject to that state if they're one of those states that tax based on that point. For existing trusts, nothing's changed from what on the previous slide except that I think I've pointed out that you really, really have to be constantly monitoring what's going on, location of all the trustees, location of all the beneficiaries. You have to see, did something happen during that year where the grantor trust status ended? Did the grantor die? Did they move? All these things are pertinent. So location, location, location is what this is about. So we have to be aware of that. But as a parting thought, while there's so many things to worry about in these trusts to see where they're taxed, the one thing you don't need to worry about is if your beneficiary moves to Idaho. They don't care. Thank you.